Stocks on Wall Street edging higher Thursday afternoon, one day after the Federal Reserve cut interest rates as expected. Rallying shares of Microsoft and healthcare shares leading this uptick. Joining us for more on buybacks and also healthcare stocks is Terence Gabriel. He is Thomson Reuters Stocks Buzz editor. Welcome back, Terence. So Microsoft and Target both rallying after issuing a announcing huge share buybacks, $40 billion in the case of Microsoft, $5 billion for Target. Should investors be applauding this?
Well, certainly it's getting a lot of attention. The question is, how are these stocks doing here relative to the overall market? Actually, when you look at the performance of the S&P 500 buyback index, which is an index that tracks the 100 companies within the S&P 500 with the largest buyback ratios. It has a very similar pattern, of course, to the overall S&P 500, but actually, since peaking in early 2018, the net trend has been for that index to underperform the S&P 500. Now, part of that may be that a lot of these companies that have undertaken buybacks, certainly those were supercharged after the tax cuts. That may be starting to wane, and that may be something that's sort of overall holding back this group. So it remains to be seen if we'll start to see buybacks pick up again. Will it be a trend, or has some of the recent data will be continued to be borne out, which shows that the overall buybacks actually are declining net year over year and back to, in fact, late 2017.
Because sometimes, people on Wall Street say, aren't there better uses for the money, perhaps as acquisitions? Does it mean there's nothing else to use it for, or is it a ploy just to boost earnings?
Yes, it can be, in a sense, another form of financial engineering, which can be used to increase earnings per share ultimately. So it definitely has underpinned those companies and underpinned the market for quite some time. The question is, will it continue? And
Terence, drug stocks are rallying today, even though House Speaker Nancy Pelosi unveiled her own prescription for lowering drug prices. That is by letting the federal government negotiate lower rates for Medicare beneficiaries and other consumers. Why rally on news like that?
Well, it may be a case of the market has sort of factored in some of these concerns. The consensus seems to be that the plan might be a negative for this group, but the fact that they're rallying may mean that they have kind of absorbed for the time being some of the concerns that something like this could bring. Additionally, the question really is would it ever get through the Congress? And it does seem as if there is doubt as to whether or not that would happen. So the stocks overall, the healthcare sector, still down about 4% from its late 2018 highs. However, we have seen a very disparate performance within that overall sector.
Lastly, Terence, since you're a technical analyst, can't let you go without asking you about your thoughts on where the markets are headed. The S&P 500 now just shy of its all-time record right now, well above their 50 and 200-day moving averages, and not exactly yet overbought on the relative strength index.
Yes, S&P 500 actually had quite a good September, historically the worst month of the year on average for the S&P 500. It's actually turning in best month right now since June, best September since 2010. However, we are, as you said, right back up to the previous record highs we saw in July. And again, we point out that the S&P 500 has struggled to sustain new highs since peaking in January 2018. We've had three distinct movements to new highs. We exceeded the previous highs by 2.4%, 0.5%, 2.5%, and then the market has been sold and we've retreated. So the question is even if we can make new highs, how sustainable really will it be? A lot of that will probably depend on whether or not there's a favorable resolution to the U.S.-China trade dispute. Certainly there's expectation that that's going to perhaps move in the right direction. If it doesn't, it would certainly be a very negative surprise. That said, if the market can't really push to new highs here, there are a number of what we call gaps under the major indices that are areas on our charts where there is no trading activity because the market opened higher one day than where it closed the preceding day. Those unfilled gaps can sometimes act as magnets, can drag the market back to the downside. So the S&P 500 has a number of those, ranging down the 2940 area to the 2890 area. So if we were to start turning back down again, they certainly could be something that would drag the market lower, and then we'd have to evaluate that decline as it was developing to determine whether or not it might be more severe.
Oh, so keep in mind the magnets and also watch the U.S.-China trade dispute. Thanks a lot, Terence. Our thanks to Terence Gabriel, Stocks Buzz editor, analyst at Thomson Reuters. I'm Fred Katayama, and this is Reuters.